This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to the Luxembourg Fundcast. Welcome to the deep dive. Today, we're really plunging into the very heart of Europe's alternative investment landscape. We're talking about the Luxembourg Special Limited Partnership.
Or the SCSP, as it's known.
Exactly. We've pulled together a comprehensive set of materials for you, covering, well, everything from its essential obligations, the governing contract, that'll negotiation dance, to costs, strategy.
And crucially, the regulatory pressures, especially now, as of today, August 3rd, 2025.
Right. Our mission, to distill the most important insights, give you that shortcut to being well-informed, and maybe uncover some surprising facts about this, let's face it, incredibly sophisticated financial vehicle. Okay, let's unpack this then. Our analysis points to two core takeaways. They really frame the whole SCSP world right now. First up, the Limited Partnership Agreement, the LPA. It's far more than just a contract.
Oh, absolutely. It's basically the SCSP's constitution. It's negotiation. Probably the most critical phase in a fund's entire life. And that connects directly to the second key point. This idea of light touch regulation for the SCSP. That's definitively over.
Gone.
It's increasingly woven into a really robust European regulatory framework. It demands sophisticated governance, institutional-grade compliance. And this isn't just theory or what's coming next. It's happening right now.
Yeah.
What's truly fascinating, I think, is how these two things, this huge contractual freedom on one side and the increasing relentless regulation on the other, create this dynamic tension.
Yeah.
It completely defines the SCSP landscape today.
That tension is exactly it. It's what makes it so interesting to look at. So let's start with the basics then. What is an SCSP fundamentally, and why was it created? What problem was it meant to solve?
Okay, at its core, an SCSP is a commercial company. You need at least two partners to set it up. You've got your general partners, the GPs that carry joint, and, importantly, unlimited liability for the partnership's debts and obligations.
Right.
And then you have the limited partners, the LPs. Their liability is capped, limited to whatever amount they've committed to contribute to the fund.
Got it.
Luxembourg brought this structure in back in 2013. It was part of a major overhaul, really, of its whole partnership regime. The aim was pretty clear. Solidify Luxembourg's position as the go-to hub for alternative funds. It all builds on that foundational law of 10 August 1915, the one concerning commercial companies.
And what makes its design stand out? You mentioned the older SCS, the Société en Commandite sound. How is the SCSP different?
The key difference, and this was very deliberate, is that the SCSP lacks a separate legal personality.
Yeah.
Unlike the SCS, our research really flags this as a strategic masterstroke.
Right. Designed to replicate Anglo-Saxon partnerships, like in England or Delaware.
Precisely.
Yeah.
But here's where it gets, as you said, really interesting.
Yeah.
Even though it lacks that formal legal personality, it still seems to act, for all intents and purposes, like a distinct entity.
Yeah.
How does that actually work?
Yeah, that's the bit I wanted to ask about. How does that function practically?
Well, that's the paradox, isn't it?
Yeah.
And it's a huge, unique selling point.
Yeah.
So no formal legal personality, but it functions like it has one. An SCSP can own assets in its own name. It can have its own registered office, its own bank accounts. It can even sue or be sued, again, in its own name.
Okay.
And crucially, its assets are ring-fenced. That means they're exclusively reserved for the partnership's creditors. They're shielded from the personal creditors of individual partners, which is vital. So this design, it brilliantly solves the practical headaches you might get with a pure partnership, where assets might be awkwardly co-owned. Yeah. But it keeps the massive benefit of tax transparency, which stems from not having that formal legal personality. It's a very sophisticated solution. Offers the best of both worlds, really, for global capital flows.
That hybrid status makes a lot more sense now. Okay, let's move on to the nuts and bolts. Getting an SCSP actually set up. For an unregulated one, the sources say it's a model of efficiency. What are the steps? Formation, registration?
You're right. For the unregulated SCSP, it is remarkably efficient. The key document, the LPA, can just be a simple private deed. No need for a notary, which speeds things up.
Oh, okay.
One critical detail, though. You need 2 original copies for it to be valid. Although increasingly, people are using qualified electronic signatures on counterparts, which is fine too.
Makes sense.
Once that LPA is sorted, the SCSP has to be registered with the Luxembourg Business Registers, the LBR. You got 1 month to do that. It involves filing an extract of the LPA,
Just an extract, not the whole thing.
Exactly, just an extract. And that extract then gets published in the electronic gazette, the RESA. That's the Recueil électronique des sociétés et associations.
Now, privacy. That seems to be a really big draw for investors with the SCSP. What does that public extract actually show? And more importantly, what does it keep private?
Yeah, the cleverness is definitely in what's not published.
Yeah.
The law is specific about what must be disclosed. The GP's identity, the partnership's name, its purpose, registered office, who the manager is, their signing authority, how long the partnership lasts, that sort of thing.
Okay.
But, and this is the key point, the identities of the limited partners and the size of their individual contributions, those are explicitly not required to be published.
Exactly.
That provides a really robust shield of confidentiality. And you can imagine that's highly valued by big institutional investors, family offices, high net worth individuals.
Absolutely. So privacy is a major plus. What about the internal side? Record keeping, ongoing governance, what's required there?
Right. So beyond the public filing, there's a requirement for a meticulous internal partners register. That has to be kept at the SCSP's registered office.
Okay, what goes in that?
It needs an up-to-date, certified copy of the LPA itself, a complete list of all partners, GPs, and LPs, and a detailed ledger showing their partnership interests and any transfers of those interests.
Pretty comprehensive. And governance.
Governance is strictly dictated by the LPA. Management is usually entrusted to one or more managers, could be the GP itself, but there's a crucial rule here, particularly for LPs. They must avoid external management. That means representing the partnership to third parties.
Why is that so important?
Because if an LP crosses that line, it can completely shatter their limited liability protection. They could suddenly find themselves exposed to unlimited liability, just like a GP. It's a very clear boundary.
Okay, noted. What about accounting and transparency on a broader scale?
Well, for accounting, unregulated SCSPPs don't actually need audited annual accounts. They just need to maintain proper books and records. That changes significantly, of course, if it's a regulated vehicle.
Like a SIF or an AIF managed by an AIFM.
Exactly. Then audited reports become mandatory. And thinking about global transparency, the SCSP is fully plugged into things like FTICA and CRS reporting. That's handled by the tax authorities here, the ACD, Administration des Contributions Directes. And you've also got upcoming rules like DD8, which will expand these automatic information exchange requirements. Soon they'll cover things like crypto assets, too.
It really is quite something, isn't it? An entity without legal personality achieving such a high degree of, well, privacy on one hand, yet being subject to these really rigorous international reporting standards on the other.
It really speaks to its engineered sophistication, I think.
It certainly does. Let's dig into the absolute heart of the SCSP now. The limited partnership agreement itself. We've called it the fund's constitution, emphasizing its contractual supremacy. What are the key things typically laid out in this vital document?
The LPA is absolutely paramount. It allows for a truly bespoke vehicle because it can override most of the default rules you'd find in Luxembourg company law. And these aren't short documents either. For a complex institutional fund, you could easily be looking at hundreds of pages.
Wow. Okay, so what are the big sections?
Well, you'll always have a section on capital and partnership interests. This defines how contributions are made, whether it's cash, assets in kind, services, even know-how. And there's no statutory minimum capital requirement, which offers immense flexibility.
Right. And then the economics. Distributions and the waterfall. Sounds like the engine room.
It really is the core financial agreement between the GP and the LPs. The waterfall is basically a tiered system for carving up the profits. Typically, the first distributions go to return the LP's contributed capital.
Okay, makes sense. Get your money back first.
Exactly. Then, often, a preferred return or hurdle rate kicks in. For the LPs, you often see something like 8% per year mentioned. After the LPs get their capital back, plus that preferred return, the GP often enters what's called a catch-up phase.
Catch-up? How does that work?
Think of it like this. If the ultimate profit split is meant to be, say, 80% for LPs and 20% for the GP's carried interest, well, after the LPs get their pref, the GP might then take a very high percentage, sometimes even 100% of the next slice of profits, until their share catches up to that overall 20% target.
Okay. So they get brought up to speed before the final split kicks in.
Precisely. And then you typically revert to that 80-20 split for all the remaining profits. Now, to protect LPs, especially if distributions are made deal by deal rather than waiting until the whole fund liquidates, you absolutely need strong clawback provisions.
Clawback.
Yes, this is a legal obligation on the GP. If it turns out they receive more carried interest than the fund's ultimate performance justified, the clawback forces them to return the excess. It's a crucial safety net for LPs.
Very important. Beyond the money side, how does the LPA handle management and governance? And what if a partner, doesn't pay up? Defaults.
Good questions. The management and governance clauses clearly set out the GP's or manager's powers. Often they also include limits on that authority, maybe on investment size or how much debt the fund can take on. They also establish the LP Advisory Committee, the LPAC. It's a really important consultative body for the LPs, giving them oversight and a voice, although it doesn't usually make binding management decisions itself.
Okay, consultative, not directive.
Exactly. The LPA also meticulously covers the transfer of interests, how LPs can sell or transfer their stakes. This often requires a formal transfer agreement and is essential for the secondary market to function.
Right.
And finally, you have robust defaulting partner provisions. These spell out what happens, and the consequences are usually severe if an LP fails to meet a capital call, meaning they don't provide the money when the GP asks for it.
What kind of consequences?
Oh, it can range from suspension of their voting and distribution rights, charging penalty interest, right up to forcing them to sell their interest at a discount, or even forfeiting it entirely. It sounds harsh, but it's the LPA's ultimate enforcement tool. It ensures LPs honor their commitments and protects the fund from disruption.
Understood. So, putting all these complex pieces together, negotiating an LPA sounds, intense, far from straightforward. What's that process actually like for the people around the table?
Intense is a good word for it. It's anything but a simple tick-box exercise. The LPA negotiation is genuinely a high-stakes process. You often have GP and LP interests pulling in opposite directions.
And they both claim market standards supports their position.
Exactly. Both sides frequently invoke this idea of a market standard, which, as the sources note, is notoriously fluid and subjective. It becomes a real battleground.
Where are the main flashpoints typically?
Economics, fees, and expenses, that's always a big one. LPs will really scrutinize how management fees are calculated, what exactly counts as a fund expense versus just being the GP's own overhead.
Right.
They want to ensure only legitimate fund costs are charged back to the fund and ultimately to them.
Makes sense. What about accountability, control?
That's the other major fault line, governance and fiduciary duty. You see large institutional LPs, for example, pushing hard for expanded GP fiduciary duties. They might also push for things like no-fault divorce provisions.
No-fault divorce.
Yeah, basically giving a supermajority of LPs the power to remove the GP without having to prove cause, like misconduct. It's about having an ultimate lever if the relationship sours badly.
Interesting. And you mentioned the ILPA, the Institutional Limited Partners Association. How do they fit in?
ILPA.
Yeah.
Their influence is huge. Even though their model LPA and guidelines aren't legally binding documents, they act almost like a shadow regulator. Well, they provide a powerful negotiation and benchmarking tool, especially for LPs. They set out principles, standard terms.
Yeah.
It reduces the information asymmetry between experienced GPs and LPs and effectively shapes market practice almost as much as formal regulation sometimes does.
So the LPA negotiation also reflects the wider economy.
Absolutely. It's a mirror to the prevailing economic climate. For instance, the increasing use of fund-level finance, things like subscription credit lines, that's led LPs to demand much more transparency and specific contractual limits on how much leverage the fund can use. They're worried about risk, but also performance distortion. And right now, with higher interest rates, slower M&A activity making exits tougher, negotiations are really zeroing in on liquidity and exits. LPs are pressing GPs hard for clear strategies on how they'll return capital. They're questioning things like recallable distributions, pushing for asset sales maybe sooner than the GP would like.
So it really is dynamic.
It absolutely is. If you connect this to the bigger picture, the LPA isn't just some static legal document. It's a living, breathing contract. It directly translates macroeconomic pressures, opportunities, investor sentiment right into its terms. It is truly the strategic blueprint for the fund.
That perspective, the LPA as a living document, is incredibly valuable. Okay, let's switch gears slightly to the practicalities. The when, what, and how much. What are we looking at for timelines? Getting an SCSp actually launched and operational.
Well, the SCSp offers this useful kind of two-track system for time to market.
Yeah.
If you're going for an unregulated SCSp, it's exceptionally quick.
How quick?
Because it doesn't need prior approval from the regulator, the CSSF, the Commission de Surveillance du Secteur Financier. It can basically be operational as soon as it's registered with the LBR. You're typically looking at just 1 to 3 weeks.
Wow, that is fast. What about regulated SCSPs?
That's the other track, and it takes longer. A Reserved Alternative Investment Fund, a RAF, structures in a CSP that's quicker than going for full, direct CSSF supervision because it relies on the authorized AIFM for oversight. But it still takes time.
And the fully supervised ones, SIFs or SICARs.
Right. If your SCSP is structured as a SIF, a specialized investment fund, or a SICAR, an investment company in risk capital, then you're looking at a much more involved process. You need full CSSF authorization before you can launch. Realistically, that process takes about 4 to 6 months.
Okay, significant difference there. What about costs? Setting it up and then the ongoing running costs.
For setup costs, you've got the mandatory registration fees with the LBR and RESA. Then the big chunk is usually professional advisory fees, legal, tax structuring advice, and of course the drafting and negotiation of that all-important LPA.
Right, that negotiation we just talked about.
Exactly. Then you have the ongoing costs. This is more of a web. You've got annual maintenance fees for the GP entity itself, fees for the central administrator who handles things like NAV calculation and investor relations.
And the depositary.
Yes, depositary fees are mandatory for regulated AIFs. And if it is a regulated AIF, you'll also have fees for the appointed AIFM plus the statutory auditor.
Any ballpark figures, say, for a smaller fund?
Market estimates suggest that even a relatively small SCSP structured as a RAIF could easily incur ongoing service provider costs in the range of, say, 100,000 to 200,000 euros per year.
Yeah.
Unregulated structures would generally be lower, of course.
It's clearly not just the raw numbers, though. It's understanding how these professional services are actually priced. Is there an art to it? And are there hidden costs investors should watch out for?
Yeah, pricing isn't arbitrary. It reflects different service models and the value delivered. You might see project-based pricing for specific things like the fund launch, or retainers for ongoing support, or just traditional hourly rates for ad hoc advice.
And what drives the final price?
It really scales with complexity. The SCSP's regulatory status, the number of investors, the number and type of assets, the expected transaction volume, all that feeds in. Just maintaining a single legal entity within a fund structure can easily cost, say, 25,000 euros a year, factoring in both direct costs and internal time.
And hidden costs. You mentioned VAT.
Yes, VAT leakage. This is critical and often underestimated. While the management services provided to qualifying AIFs are generally VAT exempt in Luxembourg, many other services the fund procures might not be.
So the fund pays VAT it can't recover.
Exactly. Luxembourg's standard VAT rate is 17%. If that applies to a service the fund buys and the fund can't reclaim it, that becomes a direct, non-recoverable cost. It just eats into investor returns.
Yeah.
Silent drag on performance. So meticulous VAT analysis up front is essential.
Okay, that's a really important practical point. And transfer pricing, TP, how does that fit in?
Right, transfer pricing. While it sounds like a niche tax compliance issue, it actually provides the essential conceptual toolkit for justifying all the fees and cost allocations within the fund structure, especially between relating parties, like the fee paid by the SCSP to its GP manager entity.
It's about proving the fees are fair market value.
Precisely. It's based on the arm's length principle. Would independent parties agree to this fee? You use established methodologies like cost plus for administrative functions to demonstrate that the internal charges are justifiable, both to tax authorities and increasingly to sophisticated investors.
So understanding those pricing dynamics and potential hidden costs like VAT is really key. Let's zoom out again to the bigger picture. Why has the SCSP been such a phenomenal success? What are its core, unique selling points that explain its dominance, particularly in alternatives?
Well, its success really rests on several key pillars. First and foremost, as we've discussed, is its unparalleled contractual freedom. The ability to tailor almost every aspect, operational, economic, governance through the LPA, is its most cherished attribute.
Flexibility, number one.
Absolutely. Then there's its exceptional tax efficiency. Being tax transparent for corporate income tax and net wealth tax in Luxembourg is huge. With careful structuring, you can often achieve exemption from municipal business tax, too. And critically, distributions from the SCSP back to investors generally don't suffer any Luxembourg withholding tax. That directly enhances net returns.
And that confidentiality piece we discussed earlier.
Definitely a major factor. that confidentiality, keeping LP identities and contributions out of the public register, remains a cornerstone of its appeal. For unregulated structures, the speed to market is also a significant competitive edge. Being able to launch in weeks, not months, is very attractive.
And the global angle.
Yes. Finally, and this is crucial from a global perspective, it's the familiarity to international investors. Because the SCSP was explicitly engineered to mirror Anglo-Saxon limited partnership models.
From the UK, the US, Asia.
Exactly. It makes it an intuitive, comfortable choice for fund promoters and institutional investors coming from those common law jurisdictions. It feels familiar. So you see, it's really more than just a legal structure. It's become a strategic piece of financial infrastructure.
So connecting those dots, what's the profound strategic purpose here?
I think it's fair to say its most profound strategic purpose is to act as a common law bridge into civil law Europe.
A common law bridge. Explain that a bit more.
By meticulously replicating the legal and operational concepts of, say, English or Delaware partnerships, it created this familiar, comfortable, and highly efficient entry point for the enormous pools of institutional capital managed out of places like London and New York.
Oh, okay.
The SCSP essentially allows those managers to access the EU single market using a vehicle that speaks their language, both contractually and conceptually. It translates those common law fund ideas into a format that is compliant within civil law, domiciled within the EU. It genuinely bridges the world's two largest capital market legal traditions.
That's a really powerful way to frame it. A common law bridge into civil law Europe. But, as we've already touched upon, the ground is constantly shifting. The environment for the SCSP is anything but static. So, thinking about today, August 3rd, 2025, what's on the regulatory horizon? We mentioned creeping regulation earlier.
Indeed. Creeping might even be understating it now. The SCSP is being, progressively and inexorably drawn into a much more robust, much more harmonized European regulatory framework.
What's driving that mainly?
A key driver right now is AIFMD2. That's Directive EU 2024-927. EU member states have until April 16, 2026 to transpose it into their national laws, but its effects are already being anticipated.
And what are the big changes AIFMD2 brings?
For funds involved in lending private debt funds, it introduces a harmonized EU regime for loan origination. This comes with new obligations, like retaining 5% of the nominal value of loans originated, and importantly, leverage limits.
Leverage limit.
Yes, 175% of net asset value, or NAV, for open-ended loan funds, and 300% for closed-ended ones.
Okay, what else?
The delegation model, where managers delegate certain functions, is fundamentally preserved. But the oversight requirements are definitely enhanced. Managers will need to provide more detailed information to regulators about their delegation arrangements. For open-ended AIFs, there's a big focus on liquidity management. Managers will have to choose at least 2 liquidity management tools, or LMTs, from a new EU list, things like redemption gates or swing pricing.
And for investors?
More transparency. Enhanced investor disclosures are required, demanding a much more granular breakdown of all fees, charges, and expenses borne by the AIF.
Okay, so AIFMD2 is a major piece. What about developments specifically within Luxembourg?
At the national level, a really significant one is CSSF Circular 24856. This came into effect back on January 1st, 2025. It's crucial because it replaced the old Circular 0277 and sets out a comprehensive framework for how regulated funds must deal with NAV calculation errors and breaches of investment rules.
And who does this apply to? Does it hit SCSSF?
Its scope is key. It applies to all undertakings for collective investment, or UCIs, that are directly supervised by the CSSF. And that explicitly includes SCSPs that are structured as SIFs or SICARs.
But not unregulated ones or RIFs?
Generally, no. Unregulated SCSPs and RIFs fall outside its direct scope, as they aren't directly supervised in the same way. But for those SCSPs that are in scope, the SIFs and SICARs, this circular is highly prescriptive. It sets specific tolerance thresholds for what constitutes a material NAV error, and it mandates detailed procedures for fixing errors, compensating investors if necessary, and formally notifying the CSSF.
Right, much stricter process there. Are there any other key developments SCSP managers should have on their radar right now?
Yes, a couple more worth flagging. The ESMA guidelines on ESG names. These started applying late last year, 2024. Though there was a grace period for existing funds, they impose quantitative thresholds if funds want to use ESG-related terms in their names.
Like sustainable or green.
Exactly. For instance, a fund calling itself sustainable generally needs to meet an 80% threshold for investments aligned with that characteristic. This directly impacts SCSPCs operating in the sustainable investing space. And sort of underpinning a lot of this is the ongoing implementation of DC-8. This continues the trend of expanding tax transparency, requiring reporting on new asset classes, notably crypto assets, and generally tightening that global net of automatic information exchange between tax authorities.
So, putting all these pieces together, AIFMD2, the CSSF, circular ESG rules, DSCA, what's the cumulative effect?
I think the cumulative effect really signals the end of an era where unregulated might have been, perhaps misleadingly, interpreted by some as unsupervised. That's clearly no longer the case. The strategic advantage of the SCSP is subtly shifting. It's moving away from just being about a lack of regulation towards being about leveraging a highly flexible platform that is now governed by an institutional quality, robust, and increasingly forward-looking compliance framework.
That's a crucial shift in perspective, definitely, for anyone involved with SCSPs. Okay, to bring this all home, let's quickly recap our 2 essential takeaways for you, our listener. First takeaway. The limited partnership agreement is the fund's constitution. Its supremacy and the absolutely critical nature of its negotiation cannot be overstated.
Right. And second takeaway. The light touch era for the SCSP. It's definitively over. It now operates within this dense, interconnected web of European and national rules. Sophisticated governance and institutional-grade compliance are no longer nice-to-haves. They're an absolute necessity.
Exactly. So the Johannesburg Special Limited Partnership, the SCSP, it absolutely remains a formidable and highly effective vehicle for alternative investments. It's still prized for that contractual freedom, the tax efficiency, the confidentiality. However, successfully deploying it now, in 2025 and looking ahead, demands a new level of expertise. One that skillfully combines the, let's say, the art of legal drafting with the science of building a truly robust compliance framework. And perhaps a final thought for you to consider. How will these evolving and intensifying regulatory demands continue to shape the competitive landscape, not just for SCSPs, but for all alternative investment vehicles globally? Something to ponder. This podcast uses AI-generated content. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.